Thank you for that report. Then committee education on the new GASB rules. Yes, the meat of the matter.
Musical chairs.
Musical chairs. So thank you for inviting us to come and share this information on this important topic with you. With me, I have Rick Reed, the system actuary, to my right, and Phil Burkholder, who's a part of our compliance area in the financial services branch, who's been coordinating the research on these two GASBs, as well as some upcoming pronouncements that will have potentially a similar widespread effect on our financial reporting. So what we've intended to do here, I definitely have way more slides than we need, but I wanted to be able to set a frame for the kinds of questions that you might have, and so I'm hoping this can be a dialogue rather than a lecture. I would like it to be a dialogue, and so hopefully we have that information in the slide deck so we can move around as necessary to take you to examples that we have set up for various topics. I'm going to kick it off, and then Phil and Rick are going to jump in and support me with details as is appropriate or in response to your questions. So hopefully that works for the committee in terms of the framing up of the topic. Okay, so we're here to talk about GASB as we fondly know them, 67 and 68. 67 is the statement that applies to plans like CALSTRS, all different kinds of pension plans. We are what is called a cost-sharing multi-employer plan, so that is how we are framed. This statement is effective for us in this current fiscal year 13-14. It is effective for years for plans that start on or after June 15th of 2013, so that fits right in with our July 1st fiscal year. I will say that in the community of cost-sharing plans, we are actually lucky in that our employers and CALSTRS all have the same fiscal year end. One of the implementation challenges that GASB addressed during their deliberations was the fact that there could be potentially different fiscal year ends, and so how to enable employers and non-employer contributing entities to adjust to the plan's fiscal year end. So we do have something about a timeline here that was designed to address those differences, but as I said, we're lucky, we're all in the same fiscal year. Statement 68 is the statement that applies to employers and non-employer contributing entities. So we have used the word employer in this deck as a kind of shorthand for both employers and non-employer contributing entities. So in our situation, the state is a non-employer contributing entity as well as an employer. So when I say employer, I will try to also remember to say non-employer contributing entity, but if I don't, it's an act of omission on my part and not an intentional differentiation. So I just want to make sure that I set that up. In terms of the changes themselves, they separate or divorce pension system funding from financial reporting. So we have a set of standards that now apply to a financial reporting that are different than the standards that we use to actually assess the funding status of the plan. GASB did this project as a part of their normal review cycle, looking for increased transparency, consistency, and comparability among systems related to financial reporting for pensions. So we were a part of that process. There was an invitation to comment, a preliminary views document, a draft, an exposure draft, a draft of the standard, and then the final standard, as well as an implementation guide that came out for GASB 67 in June of this year. We are participating again in the implementation guide preparation for GASB 68, which will come out, I believe, probably in the late spring or in June of next year. That would be the typical timetable. Phil, do you?
The GASB is planned on having the implementation guide for 68 out in December.
Oh, so okay, thank you. Thank you. In terms of the specific changes, the thing that we probably hear the most about is the net pension liability. And in theory, it is similar to the unfunded liability with the exception that it's calculated with different methodology. So from a conceptual review perspective, you would compare the unfunded liability and the net pension liability. One is from a funding perspective and one is from the accounting perspective. And again, the issue here is how that pension liability gets reported in financial statements. It is not something that CALSTRS reports for the CALSTRS plan. We will have a share of the CalPERS pension liability for our employees, should there exist one. But for in the situation of CalSTRS, our job is to report the net pension liability to our employers and non-employer contributing entity. So it's a number that we calculate and we present through disclosures in our financial statements, but it's actually not something we show on our balance sheet. Does that make sense to people? I'll just pause here to make sure there's that I haven't been unclear. Don't you have?
Why?
Thank you. So the concept here is that the pension liability is a part of the employment exchange. So when I hire someone, I make a commitment to wages as well as pensions. And so the liability for those pension benefits lies with the person who has entered into the employer, the parties who have entered into the employee exchange rather than the plan itself. So it's a part of that exchange in terms of service. It's just a deferred payment, and as such, the liability is owned by the employer and the non-employer contributing entity.
Can you talk about how it's cut up?
Sure. Do you want?
An hour later.
I've got lots of subordinate documentation on that. So, other questions from the? Okay. So, in terms of the calculation of the net pension liability for the plan, which is then published to the employers and the non-employer contributing entity, to the extent that we have an assumed investment return, which for us is 7.5%, we get to use that as long as we have assets to pay benefits. At the point in time where we run out of money to pay benefits, we have to then use a rate that's tied to high-quality municipal bonds to discount the pension liability back to the current period. So what GASB calls it is a blended rate, and the blended rate is a combination of calculations made by including the overall investment assumption as well as the high-quality municipal bond rate in the event that we have run out of cash. And that akin is to a borrowing rate should that money not be available. Rick, please help me.
It's mostly a 20-year municipal bond.
Thank you.
Rate. So,
Thank you.
Tom, one of our members, Tom, has a question.
Yeah, I'm a little confused by that. At this point, where we have substantial assets, to put it mildly, does the blending fit in or come in with municipal bond rates?
Yes, it does, because what we do is we actually project benefit payments out in the future, and we project assets at our assumed rate of return out in the future.
So,
And at some point, we project to run out of money based on the current contributions that come into the system.
so what would the blended rate look like for us?
We've got a slide, we're gonna show you the exact
Okay,
But
but
I can
number. It's 4.85% for us, based on our 7.5% rate and the current
so that
municipal bond.
it has the effect of rather significantly increasing the liability.
Yes,
Correct.
yes.
So what I've put up here is a slide that is intended to show you the kind of disclosure GASB requires us to include. Now, we currently have a similar disclosure in our management discussion and analysis section where we show the reader what happens if the assumed rate of return shifts over various rates. So we go beyond what is required here. This explicitly provides for the GASB requirement that we show the effect of a 1% decrease or 1% increase in that rate. And you can see here that the rate is calculated at 4.85, and then we show 3.85 as well as 5.85.
Right.
And those dollars are in thousands.
And if we had, I guess if we had sufficient assets to cover all the liabilities, then there wouldn't be one. So I see.
Correct. So that assumed rate of return would be our assumed rate of investment return.
Well, yeah, but also there wouldn't be a liability because you wouldn't be blending.
There wouldn't be an NPL,
Yeah.
so, yes.
So
That's
is that,
7.5.
And we would actually discount and determine that at 7.5% also. Instead of 4.85%. So we would
I'm
determine.
just thinking the number would get to be awfully small as you escalated the rate up from 4.85 to 7.5.
It'd be smaller, yeah,
Quite a bit smaller.
yeah.
can you, are you finished?
Yeah.
I want to ask a question that's sort of similar to that. So the latest actuarial studies shows that the crossover date would be in about 30 years, right?
30 plus, yeah.
Okay. So are we discounting the liability, the payments that we have to make in the, before the crossover date at 750, and then the payments that we have to make after the crossover date at the high-grade 20-year municipal bond rate?
Yes.
And
yes.
then that adds up to our net pension liability, and then, so that's different than discounting all of the cash flows at 4.85%.
Well, then what you
But is-
determine, yeah, that's the way you determine the
liability.
actually liability.
NPL.
And then you say what discount rate, one discount rate
I see.
equals that.
Got it, so, okay.
So
Seems
then if
kind
you-
of a low rate, given that most of our obligations that we've incurred to date probably are within that 30-year period of time. I don't know, it just, the math doesn't seem to quite,
Well, it's the extension in time, though,
Yeah.
because you're discounting it back to the current date, so it has more of an impact, even though proportionally it might be less money. You're coming longer to the
Yeah.
okay.
current
okay,
date,
I
so
see
it's
what you're
that
saying. Okay,
effect.
great, thank you. Grant, sorry.
Thank you. And just to clarify, I think I know the answer to this, but you could be a system that has a significant unfunded liability, but as long as you're collecting contributions sufficient to cover the normal cost and amortize the unfunded liability, you don't have to use the blended rate.
Right, as long as the contributions coming in the future plus the current assets will cover the benefit payments, you don't use the blended rate. I mean, you use the concept, but you still use your long-term rate. So it's at the point where you're projected to run out of assets. So it doesn't necessarily mean that if you have it unfunded, you're going to use, the blended rate. Matter of fact, we expect that around the country, when we were looking at least the larger state systems, most systems will not use a blended rate. They will, in fact, use the long-term rate, so.
And most of those systems set their contributions.
Exactly, set their contribution rates, so.
Thanks.
So for systems that have an arc, in terms of the contribution rate.
Great, thank you.
The next change relates to pension expense, and I turned it off instead of on, my apologies. So we also have a change to how we calculate pension expense as the difference between the net pension liability at the end of this reporting period as compared to the net pension liability in the prior reporting period. And something else that's coming through in these changes is right now we use a 3-year period over which to amortize our gains and losses against the assumed rate of return. GASB is changing that to a 5-year period. So again, we actually have a shorter amortization of those differences in our particular methodology currently, and we are required to use the 5-year period for financial reporting purposes. So again, this really speaks to the fact that one of the challenges that we see as the plan is in and around communication. So why are the numbers different? Because they're calculated using different methodology rather than the fact that anything has particularly changed. The other thing that comes into play with this statement is the fact that we and the employer and non-employer contributing entity have to do significantly more in terms of note disclosure. So we provide more information to the reader of our financial statements around the actual calculation of the liability and the pension expense. The other difference is that we currently report in our financial statements the investment return on a time-weighted basis, and GASB is requiring that we move to a money-weighted basis. So we currently use a time-weighted basis because it's the standard methodology for comparing investment management, whereas the money-weighted really looks at what the money has done over that period of time. So it's a different methodology for calculating the return. Again, it doesn't change the return, it's just looking at it in a different way. And so because of that, we're going to have to be really clear around communication as to why the numbers are different.
Can you explain how those two calculations differ?
So in the time-weighted return, the intention in the calculation is to remove the impact of cash flows so that I can compare the success of manager A versus manager B over the same period of time in managing the money, whereas the money-weighted return accounts for the actual value of the assets over that time period. So it would weight a period of time where I've got 2 million invested more extensively than a period of time where I've got 1 million investment. So it's, you know, it's a different kind of standard. The money-weighted return is also denominated, or people use the modified Dietz method to calculate it. And again, the intention is of those calculations are different. One is intended to level out the control the investor has over the cash flows into and out of the portfolio. The other is really looking at the portfolio return based on the investor's perspective. So
Another way that we've looked at it is if 25 years ago you earned, a 20% return on, $10 million, and today on, a portfolio of 150 million, you had a negative 2% or a negative 10% return. Today's amount of return is a lot greater than 25 years ago, so it's more, what we'd say, valuable or more weighted more heavily.
And when have we used the time-weighted return?
I think we typically use the time weighted.
that's our
way we
standard.
report.
For what purposes?
So we would say our average return, if you average those 2 years together, would be the plus 25 and the minus 10. But on a money weighted basis, because the amount of money you've actually lost is more than the money you lost 25 years ago, it would be a different return.
Right. No, I understand
Yeah.
I understand
Right.
the differences, but I'm trying to understand for what I mean, we have so many different purposes for which we're reporting returns in our financial statements or in our investment reports or actuarial reports. Where do we use the time-weighted return now?
the financial statements currently use the time-weighted return as we discuss returns in our management discussion and analysis. The actuarial reports also use a time-weighted return, and I think that is also our typical reporting methodology for investment performance.
So when we predict or make a assume investment rate of return, if we think for example, if the investment environment is going to be similar to 25 years ago, then we would expect a similar return on the assets. So that's basically a time-weighted versus a money-weighted return on the two. Or if we thought it was a combination of 25 years ago and last year, we would take a combination of the actual time-weighted returns to make a prediction of what we thought the return would be based on those investment environments versus a money-weighted return.
Okay. Thank you.
Yeah.
Okay, the next slide really talks about the actuarial considerations, so I'm going to ask Rick to go over these in terms of how we're going to implement them.
There are going to be some substantial changes in the way that we produce numbers for financial reporting. One of the big changes is that right now we give you separate valuations for the defined benefit supplement, and the cash balance plan. For financial reporting purposes, they're all going to be combined together into one. And we actually, for the cash balance and the defined benefit supplement plan, we're going to change the normal cost calculations. So right now, we use something called a projected unit credit, which is sort of here's for the defined benefit supplement plan, here's the increase in the members' account balances over the past year, and what we project for the following year as the actual cost of the program. We're going to use the same cost method that we use for the defined benefit plan called inter-age normal. So it's going to change some of the numbers in that respect, and we're going to combine all of the assets and all the liabilities together. So the actual net pension liability for the combined plans will be different than the three plans individually. Does that begin to make sense, or is that?
So there will be two different calculations of what the normal cost is? Is that what you're saying?
For the defined benefit supplement and the cash balance plan, yes, there'll be two different ways of calculating the normal cost.
But not for the defined benefit plan?
Not for the defined benefit, we'll still be using, the entry-age normal way of calculating it.
So for the what we call the STRIP, the State Teachers Retirement Plan, that will be calculated under this methodology. So it will take the components of the State Teachers Retirement Plan and blend it together, and everything will be done based on entry-age normal, which will be different than the methodology that we use in the valuation for the defined benefit supplement and the cash balance plan.
And because of the financial reporting, it'll be one big number, it still won't be easily comparable to the three different ones that we present. So even, at 7.5% and 4.85%, there was some comparability if you just did them separately. But now, since the three plans will be combined into one, then, the record count and all of those information will not be as directly comparable, especially
So
the
the
liability
net
number.
pension liability that we will be reporting will be for all three?
Will be for all of the,
They're
yes.
combined, okay,
So it'll be one, not three.
okay.
So the other thing that's on here is the communication challenges that we may be facing as we distribute this information to our business partners in terms of employers and the non-employer contributing entity, because we need to be able to help them understand what we've done so that it can be, so that they can use it with confidence in their financial reporting. Okay, so this really reflects the calculation. So what we have here is the total pension liability and our net position that shows the employer and non-employer contributing entity net pension liability and the net position as a percentage of total pension liability. So this just gives you the 166,872 billion and in its what I'll call its grossed up form. So it takes the total pension liability and just subtracts our reserves.
One caveat, this is just based on the DB program for comparison
Oh,
purposes.
thank you.
So it doesn't
Thank
include DBS and CB right now, but the actual numbers, when we present it next year, will include those two also.
So that's true of all the data in the presentation. It's all just DB.
Question from Tom.
Yeah, I'm sorry, this is a little off the point of the slide, but it was something you said on the last slide. And you mentioned it before, we don't report this liability number. When we report to an employer in the system, do we report their proportionate share? Or do we report, here's the whole number, you're part of the system, and
We're going to report the entire numbers.
Yeah.
The employers will be computing their own proportionate share to report on their financial statements.
And do we help them do that by saying your retirees are X percent, or?
So what I did is I skipped to a
sorry.
couple of slides with examples, and these are just meant to be examples, so I don't want anybody to think that this is real data. What we will have is a schedule. We'll have two new schedules. This is a very small subset of one that will include a list of all of our employers and their contributions and then the percentage that their contributions are of the whole. So you see here the state of California twice because they're both a non-employer contributing entity and an employer. But beyond that, we will have a list of our 1,700 public and publicly chartered schools that we will show the actual contributions. And here we are planning to use the current year contributions. So that's the methodology that we're planning to use. And then we'll show the percentage that that particular employer constitutes as the whole. And then the next disclosure has to do with how do we get from the net pension liability as it stood at the beginning of the financial reporting period to what it stands at the end of the financial reporting period. And so to get to that difference, which is the pension expense, we will show in a second schedule for the plan as a whole. This is last year's NPL. These are the deferred inflows and outflows, the changes in expense, and this is this year's NPL. And then it is up to the employer in terms of their policy as well as their auditors to determine the allocation methodology. So we will provide the information.
So I guess that's my question, because if the demographic composition of both the workforce and the retirees vary from district to district, how did they do that?
Well, so GASB gives us the option of attempting to predict the proportionate share of contributions over time, but we have made an internal assessment that that is not feasible for us to do because we don't have visibility into those plans. So what we can share with the employer is the current proportion of contributions that they're making. That's why the actual allocation of these numbers that we'll present becomes a decision on the employer level, because we're really not in a position to make that decision.
Can I just ask one question? Just
go ahead.
in terms, are we getting ahead of ourselves? Because I want to make sure we go back to where we were. And I'm happy because I think this is, what you're onto is the meat of what we want to discuss. But
Okay.
I'm wondering whether there was some more preparatory work to get to there. I leave it to you, but, because I had a question on that, on the last slide, but if we want to focus on this, we can. I think there will be a lot of questions on
So
this issue.
again, this is your education, and I'm happy to do whatever suits you. So again, this is the overall calculation, and then the other
Can I just ask one question?
Sure.
Going back, given that our, the market value of our assets as we measure them today is about 165 billion, what is the difference between that and planned fiduciary net position, which is $30 billion less? And I know it might have to do with the date, but what is the difference between the market value of our investments and planned fiduciary net
There
position?
are a couple of things going on between the market value of the assets on the date that we did this and the market value used for the DB plan. You got to subtract out the DBS and the SBMA are two big chunks. That's
Okay.
about 18 to 20 billion right there.
Okay,
And so CB is a little bit, and then there are some other things going on.
okay, thank you.
So right there, there's about 2/3 of that,
Okay.
or maybe even more, so.
Thank you. Okay.
Fine, thanks.
So that's the allocation of the assets across the various programs. So again, it's important to remember that this is just DB.
Right.
Thank you. So again, we talk about the disclosures, something that we already do in MD&A, but GASB is specifying that we need to disclose those formally, make sure that they're audited, and show in particular a 1% decrease as well as a 1% increase. This then gets to the allocation questions, Tom, just in terms of showing the fact that these disclosures are required. We have some further slides that talk about what if, who owns the liability, but this schedule is in fact required. Where our plan originated was with some basis in terms of what the AICPA was talking about. GASB has not been terribly specific in terms of how to present this information, but the AICPA has had a working committee on this topic, and so they actually put out some examples related to cost-sharing multi-employer plans that we have leveraged in terms of our determination of what makes sense for us. So we're not using the exact presentation that they provided, but it's similar. GASB, like I said, allows you to predict the proportion of contributions in various ways, and we have made an assumption in this methodology that we're going to use the current contribution distribution to perform this calculation from a practical perspective.
But that's not necessarily what may be adopted by the employers.
Yes, and I think what Dr. Yetman is alluding to is that what we have control over is what we display. We also have a responsibility to make sure that information has been audited and is calculated in a way that people can rely on, but it becomes an employer responsibility to actually present this information in their financial statements, which is, again, our concern around how many phone calls we're going to get, both us and our auditors around these particular calculations.
GASB chose not to just tell everybody exactly who's responsible for this. They didn't go there. They didn't want to put a requirement on the plans that they had to provide this information. I think they also recognized that we were the best suited to provide that information, but they chose not to put in the statement who is responsible.
And in addition, the employers do not have to use this method to do the allocation. So although this is presented, and an employer might take, school district one might take that 1.6% and multiply it by our net pension liability to get their allocated portion, they don't have to do that way. They can pick, there are other methods in which they could use also. So we could have the possibility of a number of school districts using different methods.
Right, if they think their demographics are going to change, they would have that information where we don't. So the way, perhaps another way to look at this is that we present something that adds up to 100%. If you take the various employers and add that up, it's not necessarily true that it's going to equal 100% of the number that we have presented. And Dr. Yetman is assuring me that it won't, but So we are responsible for making this information available, but then it is the responsibility of the employer in consultation with their policy, financial policies and their auditor to make the determinations for themselves.
So, can a school district then decide that they're just not gonna show any of it? I mean, what's the leeway they have?
Well, I think that's up to them and their auditor in terms of their view or interpretation of their responsibility related to the liability. So maybe what I should do is move on to we do talk about impact to the state and the employers. So let me skip through some and we can come back to these if it makes sense.
Excuse me, Raina.
I'm sorry,
Before we move
Lorraine.
on, I had a quick question. When you say this district can choose some other methodology, can you say more about that? I mean, what leeway do they have to use different data, or you mentioned demographic data, but are they going to start with a baseline of the information we're providing about the status of the fund?
GASB gives them some options. The GASB's preferred option is that they project out what they see their demographics being and how they're going to fit those. The other option is one that we're providing, which is based on contributions or some decent or reasonable methodology that you can figure out what the best proportionate share is. So there is a framework within the statement that they have to follow, but it does give them some options. They don't have to follow what we provide. So
what we're trying to begin to talk about here is the impact of CALSTRS funding, and what happens in situations where the plan is funded, and the impact then that has on the state as the non-employer contributing entity and the employers. So to the extent that there is a funding solution, it would in fact have the effect of reducing the NPL, as we discussed previously, because the discount rate would change, we wouldn't be running out of money. So I think that's certainly something that we have discussed. In terms of the impact of this number on the state and employers, the most tangible impact that we have anticipated and we are seeing is the impact as people begin to get ratings for debt. So to the extent that there is a large liability or deferred responsibility, that can have an impact on ratings for debt. We have seen that in some cases in the write-ups that are coming out in the last 3 to 6 months. It also is the case that this information has been available in different forms, so it could already be built into those ratings. But in terms of talking with people, that is the impact that we see. The next question or slide really relates to the ownership of the liability. So where does it sit? So what we've paraphrased here is the fact that GASB is requiring that plan employers and non-employer contributing entities report a proportionate share of the CALSTRS net pension liability. And it, as Phil alluded to, in GASB's written document, it's not clear how that liability gets presented. So there is language around it. It does separate out from an example perspective of a situation where employers are responsible for the ARC, but there's a guarantor, which is not our situation. It doesn't really talk about our particular situation. So what we did here was to look at it from both views. So if in fact it was the state's liability, the state would have the NPL in their financial statements. If it was the employer's liability, we looked at it in terms of impact on, some typical small, medium, and large school district. And what you see here in the gray portion of the bars is an existing encapsulation of some set of liabilities today. And then what the red does is to add to that a proportionate share of the NPL to show the scale of the difference. These numbers mean nothing. They're just examples, but they're based on data that we have about a typical small, medium, or large school district, just so you can see what it looks like. And again, these are based on the DB plan and our June 2012 actuarial valuation. So again, it just is a scale. It's not, the numbers themselves don't have particular meaning.
Robin, so with the small district, what does the 21 million represent? Is that that's their proportionate share of the actuarial liability as our actuaries
No,
calculated?
that's just their typical balance sheet liability
Oh,
now.
just what they would have
Right.
normally
What
on
they
their
would normally
balance sheet
have,
from
and so
other
that's gone from
liabilities.
21 million to
I
49
see.
million.
Okay.
So again, what we're trying to show is the scale here. We really wrestled with whether these numbers or how to present this, because we can't say this is any particular entity's data. It just gives you kind of a feel for what happened. So I definitely want to put that caveat on here. It's not relevant for any particular employer. It just looks at employers in California that are small, employers in California that are medium, employers in California who are large, and what you might find typically in their liability frame, and then what happens when we allocate the NPL.
And I think we can say it will be at least doubled. So,
Right, so that's, and it's,
The actuary is absolutely correct, but remember, this slide assumes that the state, that all of the liability is being allocated to employers, and that none was allocated to the state, whereas the previous slide said, what if it's all allocated to the state, so none would be allocated to the employers.
So in this methodology, I do
Tom
want to
has a
say
question.
that the non-employer contributing entity, which is the state, does have their proportionate share based on their contributions in and around the 2% number. So that's the only correction. It is allocated.
Okay, Tom has a question.
It just struck me that the proportions of increased liabilities are very different. A double, a quadruple, a triple. Is that just because of the randomness of the examples you picked, or, okay?
Yeah, it really, so again, we scanned, we picked something that looked in the middle. So some of this just has to do with the debt load that is on a balance sheet of that particular district now versus the proportionate share based on their contributions.
I think the medium was based on the size, not the size of the liability, but the size of the school
Right,
school
yeah.
district, so.
Right. So it's based on their size from a daily attendance.
Okay.
So I'm gonna go back again to that. I'm off, okay? Thank you. So I just want to make sure we talk about the disclosures. So again, this is emphasizing the fact that from a disclosure perspective, it's going to look like the unfunded obligation for CALSTRS is different in the accounting statements than it is in the actuarial evaluation because they're calculated differently. So absolutely, they'll be different. Even if we don't get into a situation where there is the lack of cash, there are still differences. We talked about the difference between the 3-year and the 5-year amortization for the differences in investment earnings based on the assumption. So that's a difference. So there will always be some difference. It's just a matter of the significance of that difference.
Can we go back to that? I mean,
Sure.
What we have here then, it's a different way of measuring. I mean, it's not, or are you saying one is right and one is wrong? I mean,
I
mean,
am
think
attempting
the
not to make any
actuarial- I mean, the
value
70 billion is an actuarial measurement based
Correct.
on assumptions.
Correct.
And the NPL under GASB is another measurement based on different assumptions and different methodology.
Correct.
The actual amount that we have to pay is the dollars year by year by year by year that we have to pay.
Correct.
And then both of these are ways of creating a shorthand summary of what those year by year dollars are.
Right, so in the
And so they're
accountant's
different.
world, we would call this a different estimating methodology.
Right.
Let me go back. Neither one of these numbers are an estimate of the year-by-year dollars that the system has to pay. What it tries to measure is, here's what whoever owns the liability and have to make contributions will have to pay eventually on a year-by-year basis. So, they measure things a little bit different. So the system, the amount of actual payments by the system is not measured in any of these numbers that we give you. So it's the employer, not the system, because
Right.
the
Right.
system also makes money through investment returns that pays a portion of the system's liabilities. So there's,
Right.
so
Right. So what you're really saying though is these new GASB rules don't change our actuarial calculation of the liability.
yeah, they don't change the actual calculation. They don't change the management of the system also.
Right, so there are different estimating methodologies around similar topics that are not exactly the same in terms of their intention or purpose, neither of which are the actual expense over time. It's because that is something that we are just attempting to estimate. So I went back to the slide that shows the total pension liability and then the
Right. Tom?
Yeah, it actually raised two questions in my mind, and maybe it strikes me that the principal difference between the 70 and the 166, it's largely a function of discount rate. That if you use the 7.5% discount rate, the numbers would pretty well converge.
They would be much closer. What I was trying to clarify, and again, this is me being the accountant, is that they still won't be exactly the same
Right.
because there are other nuances in the methodology.
Yeah. I'm thinking a public understanding of that is going to be very important, because I think people have, a lot of what you read exaggerates the impact of the analysis of discount rate relative to actuarial funding. The other question I have is, just to be sure I understood it, if, for example, we had a fully funded plan, then you're saying really the level of pension expense people would have would be actual dollar expenditures that districts would have to make would be quite small, because investment income would be covering most payments, right?
Actually, not necessarily. So if we were 100% funded, the ongoing cost would just be would be something called a normal cost, would be the cost that you continue to incur because you have people earn more service. From a GASB perspective, as long as that cost was being covered and we didn't run out of assets, then we would use a 7.5% rate. But if we had a fully funded plan, if we were not collecting contributions and we were projected amount of money, we still would be using a blended rate based on that. So it's the projection of running out of money that causes the blended rate to kick in. It's just more likely to occur when you have a large unfunded like we
Right.
have.
Okay, I'm with you.
Mr. Unterman, so if it's, even if the plan were actuarially fully funded, what you would not have was not the expense part that you asked about. You wouldn't have an MPL. You wouldn't have a net pension liability
right.
that they'd have to pick up. But they'd still have an obligation to pay according to whatever laws were in place in the books to make their annual expense and
Right.
provision for employees. So that will always be there regardless of the plan. Well, I can't say always, but it
Yeah.
will be there under current existing rules regardless of the plan's funding. What would be absent is the additional liability that CALSTRS is going to calculate and that each district has to now go grab a piece of that's bigger than substantially bigger, as you saw, than it used to be.
Right, okay, I'm with you. Yeah, and I guess if we were significantly overfunded, then contributions could be diminished, but that's a long way away.
We don't even talk about that at this point.
I think we would all
When
love to
I
be in
was
that
when I
position.
was a corporate CFO, our pension plan was overfunded, and it was a nice thing to have.
Those were a lot of plans in the late
but-
1990s, yeah.
But I think what Tom was saying, I think, and I was trying to say it in a separate way, which is the fact that we're measuring this differently and the number has gone up doesn't mean that the amount of pension receipts that retirees are going to get has gone up, right? That hasn't changed.
It hasn't changed.
This system and what this system is going to pay to retirees does not change by the fact that we have this new way of measuring. It's just a new way of measuring the exact same thing.
That's absolutely
And-
correct.
And mostly because of the change in the discount.
Mostly, yes.
But the other important thing is that if we've enacted a funding solution, then this would go down, because it's
Correct.
based on the assumption of what contributions will be made in the future.
Right.
So
Correct.
not just investment earnings in the future, but
But also
contributions
contributions.
into the future.
Yes, exactly.
Yes, absolutely. And I'm sorry, I was flipping the slides because I was trying to get to this one that shows the deferred outflows of resources at 8.6 billion. And in that number is both the difference between the assumed rate of return and our actual return. So it's a positive. We've earned more than that, but also the cost of service that was added during the period, which is about 400 million of that number.
Yeah, so it's a small piece.
It's a small piece, but it still
in it.
exists. Okay, in terms of what we have not yet talked about here, so this really gets to the fact that as we implement this, we are going to incur costs that are really in support of our employers. So there's there's a policy here related to the use of the system's funds in support of the employer base in terms of making these calculations and in response to questions and requests for information. So that's something that we have not yet delved into because we're still in the we haven't done it yet phase, but is something we'll need to consider because we will in fact be expending the fund's resources into the, for something that we are not required to do, but that they're required to do. The other thing that has, like I alluded to in the beginning, we're lucky because our fiscal years are aligned, but there still is an impact on timing of financial statements. And what I've got here is a timeline, and I apologize to people in the back if you can't see this, but what we're talking about, and I'll use this upcoming year as an example, we will prepare our 13-14 financial statements, and they will be presented to you for acceptance in November of 2014. So as we roll that forward to the next year, we'll present in November of 2015. And the employers will need to pick up these GASB reporting changes for their fiscal years ending in June of 15. So when they're looking for our data, they could either wait until we have our audited statements in November of 15, or they could look back to our prior year statements and then roll that data forward based on what has changed. Once they make that decision, they stay with that decision. So as we go through the implementation dialogue with employers, this is one of the things that they're going to have to think about is, do they have a hard need to have their financial statements out by such a date that they won't be able to wait for ours, that they'll have to use ours from the prior year and roll forward based on information that we make available in the valuation form in April and other economic data. So again, this is going to be an issue in terms of the transition because we all are producing financial statements at the same time, and to the extent that they have a need to release those either simultaneously or before we do, it's going to impact which year they choose to use as the basis for their presentation. The other thing that we've talked about here in our discussion is just the importance of clarifying the differences in numbers. So numbers with different bases in methodology are going to have different answers. They're for different purposes in terms of presentation, and we've got to make sure that even within the body of our comprehensive annual financial report, we are clearly explaining why they're different so that we don't lose clarity in the purpose of any of that data. And that, in terms of the challenges facing us as a plan, is something that we're very concerned about because we do want to be clear that it's not that the situation is different, it's that the methodology is different, and so the estimates are different, or what, the presentation is different. And then, again, as we've alluded to, the workload associated with the fact that we have somewhere around 1,700 employers, and they have auditors, and so they're going to have questions, confirmations, those kinds of things that they'll need to engage us in. We did, in the field test for this, we did participate and estimate our additional resource requirements to deal with these statements. You will see in the budget, the initial budget requests we have tomorrow, that there's some requests based on these needs. The workload is increasing in association with actually implementing these statements, both in financial services and in the actuary. And it will trickle throughout the organization as differences come up in terms of the language of the presentation. How does communication staff help us clarify what the differences are to the reader? So there certainly impacts. And we are engaged in outreach with stakeholders. We've actually had a request to go and speak in Santa Clara County and in San Bernardino County over the course of this fall. We will continue to offer that to people. We want to make materials available on our website to the extent that we can provide electronic education through webinars. We'll do so. One of the first steps was to present this item to you. And then we can leverage these materials as we discuss the impacts with our employer community and other stakeholder groups. So, in terms of the takeaways, the disclosed liabilities from an accounting perspective increase, and they increase substantially in the event there is insufficient funding available to make benefit payments. And that to the extent that we do have legislation that would resolve our funding situation, that will obviously lower that net pension liability because we won't run out of money.
Bob?
Thank you, Mr. Chairman. Just a couple of quick points. One is, what happens if market interest rates rise over time such that the 20-year bond, just maybe 30 seconds, you can tell the board, we're at pretty low interest rates by historical standards. And so there's some people believe that they may go up, maybe they won't, but some people believe that there's a chance they'll go up in the future. And if they do rise, what happens if they rise and CALSTRS does not subsequently revise the 7.5%? And then second, what happens if they actually went above 7.5? Do you get to now do a blended discount rate still?
Apparently
Yes.
so. They didn't make any provisions for that, and that was actually discussed.
question, yeah.
Yeah, it was discussed, and yeah. And we, I guess the board chairman and some of the other members who had, lived in the late 70s and 80s when bond rates were very high, actually did make comments on those, and that was all a part of the sort of the financial economic discussion piece of setting interest rates on that.
And so if the long-term bond rate rose to equal 7.5, what would that do to the reported net pension liability?
It would decrease it. Yeah,
Yeah.
yeah.
And when did you, I know you might have other questions, but it's just on this matter. At what date did you figure out what 20-year municipal bond rate to use? Was that, because rates have gone way up in the last few months.
Right, so it'll be for our purposes, it'll be 6/30 of 12
6/30 of 12?
Yeah.
Okay.
for the
'Cause
examples, yeah.
For the example.
Today, that
Right.
rate is probably around 475. So
Yeah,
we
yeah, it's
get
a
a
lot
blended
higher
rate
now.
that's probably a lot
Right, so
higher
the
than
examples are
485.
based on a lower rate.
Yeah, and it does move, it depends on what day you,
Right.
yeah. Yeah.
Sorry, go ahead.
Mr. Chairman, then my last point is, I think it'd be useful going forward for the board to keep in mind that this net pension liability is a hot potato. Nobody wants to be the one holding on to it. And so as the school districts put forth good faith efforts to determine what percentage of it is theirs, and as the state grapples with what percentage of it may or may not be a liability of the state, there will be a settling up in a few years when we'll be able to look at the number reported by CALSTRS as the aggregate whole, and the total reported by districts and the state as a disaggregated whole, and see if those numbers are ballpark close. And GASB, in my understanding and reading of the rules, did not put forth any provisions to say, well, you got to add this up and make sure they add up. Like, there's no one responsible for enforcing that those actually add up over time. Nonetheless, I think it would be informative for the board to be informed as time goes on how closely those numbers do or don't add up. Thank you.
Tom?
I just had a quick question again about the municipal bond rates. Do you use the state's rate, or do you use the school district's rate? Do you take a blended rate of all the credits of all the different school districts participating, or?
There is a municipal bond index. So GASB didn't
it's against the
specify,
index.
but you have to work with your auditors. I think most auditors would like to see, instead of maybe individualized some school districts, is the general 20-year municipal bond index rate. So that's probably what.
Okay, so that's not rating specific,
I mean, there
or it's rating weighted. It's weighted for
So-
participation by
Right.
all the
Dozens
ratings.
of-
Yeah.
So we'll have to establish a policy that says that we're going to base it on this particular
Index.
index, and that will be written in our policy, and obviously then that'll get vetted with our auditors. We would want to choose a representative index.
Yeah.
Okay.
I have a couple more questions. Some of them are going back to some things that were said earlier. So there was that slide on pension expense, which was the difference in the net, most primarily the difference in the net pension liability from one year to the next, but also for adjustments, I think, because of the smoothing impact. So that net pension expense is also something that, is that also something that each of the employers would take a share of and put on their income statement?
Yes, as well as the deferred inflows and outflows. So they have to proportionally allocate the net pension liability from the beginning of the period, the deferred inflows and outflows, the expense, and then the net pension liability at the end of the period. So what we will present is basically, this is last year's net pension liability. These are the deferred inflows and outflows. This is the actual expense due to changes in demographics, changes in the actual investment return as amortized over 5 years, other variables, and then we'll come up with the end, and they take a proportionate share of all of that.
So do you have an estimate of what that is relative to the actual contributions that districts are currently making? Their 8.25% actual contribution?
They make 4 billion. Right?
Yeah, 4.5 or
$5 billion.
5,
4.5 or 5 billion.
as opposed to this 12.9.
Yeah.
So it's at least twice what their current pension expense is that they're showing on their income statements?
It will
Yes.
be significantly higher.
Yes.
Okay. Because that's, could be an even more
Yeah,
explosive issue.
yep.
So the employers don't have to show their share of the NPL until 15, 16.
No, 14, 15, so it'll be 6, 30,
Okay, 14,
15.
15. But we're going to be putting the NPL in our 13, 14. Are we
Correct.
also going to be putting in those percentages?
Yes, we have
We
to
will.
produce those schedules.
We do, so we do have to
Yes.
produce. So somebody who wanted to, say, a credit analyst from a rating agency or somebody like that, wanted to figure out what each,
Could do it.
they
yes.
could do their own ballpark.
Right, based on the actuals, so what they wouldn't have the benefit of is the employer's vision in terms of their
Right.
projected changes in demographics or the mix
Right.
of
Right.
staff.
So do we have alternatives as to how, on what basis we put together that schedule of the shares by employer? I mean, you're saying that we're gonna do it by contributions from the previous year. Does GASB or AICPA give us direction that we can choose a different methodology to publish in our statements?
We could, from a practical perspective, we can't envision an alternative that we have figured out how to implement. So we could try and project changes. Really what they're looking for is, as you look out into the actuarial future or the funding future, what's going to happen. But at this point, with the information that we are collecting, the current would appear to be the best basis of estimate.
Anybody else have questions? Well, great, thank you. This was extremely helpful and informative. So, review of information requests. Was there any? None? Okay. The draft agenda for the next meeting, if there are any questions or comments on that? And opportunity for statements from the public? Okay. Then I think we're adjourned. Thank you.